If you are paying yourself entirely through salary in 2026, you are probably making HMRC richer than necessary. Most limited company directors are paying far more tax than they need to, and they don't even realize it. Look, most business owners spend years learning how to make money, but very few learn how to take money out of their business efficiently. And that mistake could be costing you thousands of pounds every single year. I'm Rahim Bah. I arrived in the UK at just 15 years old. I couldn't speak English, no parent, no connection, no money, and I had no idea how to build wealth. Years later, I became an accountant, working hard but still living paycheck to paycheck. That pain is what drives me to decide to take my finances into my own hands instead of relying on my employers or the government. I started investing in property with no experience and built my way up to multi-million pound property portfolio. Along the way, I've been featured on the BBC, Business Insider, in magazines and national newspapers. I've also helped more than 2,000 professionals start and scale their own property investment journey. Many of them have gone to become full-time property investors, making working for someone an option instead of an obligation. And some have gone to become property millionaires. Welcome to the Success Blueprint. If you're serious about building wealth through property investment, achieving financial freedom, developing the right mindset, and becoming the best version of yourself through personal development, then you are in the right place. Hit that subscribe button below and let's build your blueprints to success together. In today's video, I'm going to show you one of the most common ways UK limited company directors structure their income in 2026. If you implement what I'm about to share with you, you will understand exactly how to earn more, pay less tax, and ultimately become more financially successful in 2026. Listen, if you can invest 10 minutes to learn how to make money, pay less tax, I'm afraid you remain stuck on your entrepreneurial journey. For the few of you who stick around, let's go. 1. Use your personal allowance. Most directors miss this simple opportunity. First step is usually to utilize your personal allowance. For the 2025-2026 tax year, many directors structure their salary around personal allowance threshold. Currently, that is 12,570. Write that figure down. I'll get to it later. This can help reduce company profit and may be received without income tax, subject to your individual circumstance. And this is amazing. Think of this as collecting the money HMRC already allow you to earn tax-free. If you don't use it, you're leaving part of your allowance on the table. Sorry for interrupting this video. I just wanted to draw your attention to a guide I've just created. This guide is for you if you're looking to start and scale in property investment and you've got questions that you want to ask in order to start your property investment. This guide is the ultimate guide to start and scale in property investment journey. I talk about the different type of investment strategies. I also discuss the 11 ways you can raise finance to make any property no money down deals and the type of properties to buy in order to generate a serious return in your investment. And I'm giving this book away for completely free of charge, no string attached, nothing, absolutely free. Click the link on the description of this video to get your free guide now. We've only got a limited number of these copies available as well, so click the link to get your guide now. Let's get back to our video. 2. Dividend. This is where many directors create efficiency. After taking salary, many business owners choose to take additional income through dividends. Dividends are taxed differently from salary, and that's why they are often a key to the director's remuneration strategy. As I said, bear with me, I'll walk you through this example. A common approach for any limited company business owner: salary first, dividend second, rather than taking everything through PAYE salary. And this difference can be very significant. Imagine two directors both generate exactly the same business profit. One takes everything through salary, the other uses tax efficient combination of salary and dividends. Same business, same profit, different outcome. Let me walk you through an example of how to pay yourself as a limited director so you can reduce your tax burden drastically. And by the way, this is perfectly legal. Every individual in the UK has a personal tax allowance of £12,570 without being taxed in any of it. In essence, I'm going to walk you through an example how to take salary with minimum tax on a £50,270 take-home income. Let's get to it. As I said earlier, you have £12,570 personal allowance, and that applies to anybody here in the UK. Suppose that we wanted £50,270 income with paying almost no tax. We would pay ourselves a dividend of £37,700. That gives us the total of £50,270. So from that, we take our allowance, allowable allowance, the tax-free allowance of £500. From there, we minus that 500 from the £37,500. That gives us £37,200. This then becomes the income we pay dividend tax on. Dividend tax is set at 10.75% instead of a higher income tax of 30 or 40%. So what we'll do, we then times 37,200 times 10.75%. That then gives us a tax liability of only £4,000. So in essence, on the 50,270, we only paid £4,000 tax compared to 20 or 40% tax we would have paid if we were to take the salary directly if we were to take salary using PAYE. In essence, we only paid 8% tax in our overall income instead of 20 or 40%. And that's how the smart limited directors pay themselves with paying bare minimum tax of only £4,000. And that is the key to generating wealth and making your money work a lot harder for you. This is where many business owners get caught out. Dividend tax rate, threshold, corporation tax, national insurance, and personal circumstances can change. So what works for one person may not work for another. That's why it's important to work with a qualified accountant before implementing any of these strategies. But if you do, it makes you more money. You've got to keep more of what you generate. Here's something most people never hear. The biggest tax mistake isn't paying too much tax. It's focusing so much on tax and you forget to focus on profit. That's why I strongly recommend you have a qualified accountant to deal with that. I've met business owners who are obsessed with saving £1,000 in tax whilst ignoring opportunities to make an additional £100,000. Profit first, tax efficiency second. And remember, cash flow is king. But also remember, you're making enough money to be able to pay your corporation tax, VAT, and future expenses, instead of just trying to reduce your tax burden, because end of the day, you've got to have enough money to pay your tax liabilities. Otherwise, you could accidentally spend more money that belongs elsewhere. A business account without financial planning, it's like driving a car without fuel gauge. Sooner or later, you will run into problems. Let me ask you a question. Would you rather earn £100,000 and keep £70,000, or earn £100,000 and keep £90,000? Exactly, I thought so too. You see, wealth isn't just about income, it's about efficiency and ways to create wealth. The biggest lesson I've learned in business is simple. Making money is a skill, keeping money is another skill, and investing money yet another skill. The entrepreneurs who build wealth learn all three, not overnight, but one step at a time. Comment below if you are a limited company director or planning to become one. And tell me, what is your biggest challenge right now? If you like this video or any of my videos, smash the like button below, subscribe to my channel for more amazing videos. I look forward to sharing the next one.